Welcome to Blue Dirt, the podcast that digs deep into the foundation of commercial real estate investing. Unlike most real estate shows that focus on deal making and market trends, Blue Dirt gets into the nuts and bolts of what truly builds long-term value, the building itself. We break down how to spot deferred maintenance before it costs you, why a solid preventative maintenance program is a game changer, and how triple net leases can maximize your investment returns. We'll also explore the importance of strong landlord-tenant relationships and how they drive stability and growth in your portfolio. Whether you're a seasoned investor or just getting started, Blue Dirt gives you the practical knowledge to make smarter, more profitable decisions in commercial real estate. It's time to get your hands dirty and build value from the ground up. Let's dig in. Welcome to Blue Dirt, where even idiots can make a killing in commercial real estate. Today, we're joined by Mike Price with Hub Insurance. One of our big triple net factors when we have to monetize a lease is property taxes, property insurance, and common area maintenance. So we're going to tackle one of the big three with commercial property insurance today. So let's just get started with an introduction. Mike, tell us a little bit about yourself, your company, and how long you've been in the industry.
Yeah. So like Michael said, Mike Price with Hub International. So most of the people around town probably know this as House McLeod Insurance. We've been around since about the 1960s. We got acquired by Hub International about 4 years ago. So it's been a great partnership with us. It's kind of the trend that we're going. What it's done is kind of taken the small agency that we were and kind of broadened our horizons, more markets, more resources and things like that to kind of help us out. And personally, I've been in the business coming up on 5 years, right? Everything across the board, but with a focus on commercial property insurance like we're talking about today.
Fantastic. And since Don is new to a camera system, when you have a guest, Donnie, you don't look at him because they're going to see the back of your head. You look at me, and it's almost like you're looking at him from the viewer standpoint. But when you, is
that how angles work?
We're kind of learning as we go, folks. So we're gonna make this happen anyways.
Thank you so much.
I'm a giver, and keep knocking your mic. That also is very disruptive.
Whoever installed it today
to everybody.
We had our production manager come
Yes.
in
All
today.
right. So that's been quite the debacle. Okay. Yes. So one of our largest expenses, as we mentioned, is property insurance. In the state of Florida, we have a lot of perils, including hurricanes, which we happen to be in the middle of hurricane season. Up to this point, it's been very quiet. I know that if we get a direct hit or multiple direct hits on the state, even if we get nothing in this particular area, the insurance rates for the states rise. Can you walk us through how those rates are calculated, what the global insurance market does and how it affects when a specific state or region is affected by a lot of natural disasters, whether it's hurricanes, fires, floods, all of that. And give us just a little bit of history on the rates that have gone up and down over the years, if you can start with that.
Yeah. So kind of first on what the broker side is doing as far as underwriting, it's basically what they're doing is they're taking a gamble on when they write a policy, especially here in Florida, weighing the risk for it versus
timeout. I wish I was taking that gamble because they always seem to win. They are the house, so their gamble is not the same as yours and my gamble. But keep going.
Well, hey, believe it or not, and you're not gonna like this. This year is the first year that the market has made money in I think 4 or 5 years. That is due to that like low claim activity, like you talked about. So the more claim activity we get, doesn't matter if it's here in Pensacola. If storm hits Miami, it's going to cause those rates to increase across the board because that carrier and the state has to make up those funds that they lost previously from those claims. So that's where that rate comes into play. So right now, since we've had a quiet hurricane season the last 2 years, we are experiencing what's called a soft market. So that means, go ahead.
No, I was going to ask. I've seen soft and hard markets, but I don't know what that means. So walk us through that.
So since probably about 2019, 2020, right around the time Hurricane Sally hit, we've experienced what's called a hard market. That means there's no competition in the marketplace. Nobody wants to write in the state, especially for wind and hail coverage, which most people know is hurricane coverage. So that means that there's less capacity, there's no competition, there's harder underwriting guidelines. And that's when we were seeing on your properties when something would go from 5,000 premium to 15,000. There was no other options.
Right. And part of that is because, and I've heard you talk about this over the years, is when we have one or two or more large carriers pull out of the state, it still puts a lot of pressure on the existing carriers to write these policies and And while you would think they want more business, their exposure, of course, is greater, and they're trying to mitigate that exposure.
Correct. So all of these carriers, no matter who they all have what's called capacity. So they have reinsurers that are in the Bahamas and Switzerland that fund the insurance companies and insure the insurance companies. And so they're given what's called a capacity in the state of Florida. Some of them hit that by March. They can't write anything and they have to leave the state. But now that they've become profitable, we're seeing those less hurricanes. Now there's more players coming into the state.
Back into the state.
Correct. Mm-hmm. And we've got competition. We can take things, remarket it. We're seeing broader terms. So previously you might have a $9 million building, but nobody's going to write that full limit. They're going to give you $5 million worth of coverage.
Right.
Now we're seeing people get full limits with wind included, seeing a break on premium, all because of the market kind of opening back up and experience of soft conditions.
Great. Okay. So
the money being made last year or this year,
correct,
is actually a positive.
Correct.
Right.
Yes. It's
nobody's crying for the insurance companies. I can promise you.
I meant more of a positive, like it's.
And by the way,
insurance companies enter the market so we get better competition.
I hear him, and it almost sounds like the fuzzy math from the government. We didn't make money, but yet they still.
They got to make.
Everybody has plenty of buildings and assets, and they park billions of dollars into so nobody's going to cry for the insurance companies. I can promise you. Okay. So the insurance companies, when you get a loan on a property, when we get loans on commercial properties, we are required by our by our lender to have insurance. Walk through that relationship and how you work, because this is something that a lot of times when we are getting ready to close on a property for one of our clients or even for ourselves, sometimes the insurance is the last minute to get written. And sometimes in the past, it's been a little bit complex, but you need to, when you get a property under contract, one of the first calls we make is to our insurance broker, which in this case is Mike Price. So we let them know, 90 days out from closing, hey, we have this property under contract, start working on it. But they have a few limitations that they can't write policies within a period of time. Can you walk us through that scenario?
Yeah. So, and kind of to hit on that last point, most brokers aren't going to quote anything outside of 45 days from closing.
Okay.
Especially right now during hurricane season. They're not going to guarantee you a quote, 90 days out, and the storm could come through, wipe everything away. So that's pretty much standard practice, 30 to 45 days to get a quote. So what my job is as the broker is to paint the best picture for the account and the property. So that's collecting as much information as possible that we can then take that to all the underwriters, paint the best picture, not just of the building, but of the buyer too, of your history and experience, and put everything into a package and submit that to the underwriters. Because right now we're hearing these underwriters get 50 or 60 submissions a week on their desk. And most of them are just blank, hey, quote this building. So the more details that a property owner can provide with us, that we can provide to them, the quicker it's going to shoot up their desk and get a favorable quote.
Now, when you're saying provide data on the buyer itself, I'm sure it's somewhat fluid, but what percentage of the underwriting would you say is building related versus what is buyer related? I mean, are we talking, what kind of, would you think it's
going to be the large majority on that building. Now they do take into consideration, especially with our underwriters, we have a good relationship with. We can say, hey, this is Michael Caro and Don Redhead. They manage a lot of properties around town. They're one of the premier groups, things like that. What they do is may not affect rate, but it affects for someone else to come and look at it instead of just passing it through their desk with the rest of their submissions. But most of it's built around.
So it's really more of a prioritization versus maybe an advantage on pricing or things like that.
Correct. More of the rate breaks and the help is going to come from things like updates to the building, who's occupying it, distance to the coast, roof age, the construction type. All of those things are what gets measured and put in when they spit out basically what's called a rate for the people at home. So a rate is all of those things that they take into account in underwriting. They take that rate and they multiply that by the TIV. So TIV is total insurable value, whether that's the building value, whether that's if you're buying it and using it yourself, you have contents coverage, if you have loss of rents, all of that is what's called TIV. TIV multiplied by the rate, and that's how they get your premium.
So when we buy a property, we just closed on a property. Today's Friday. We closed on another property Wednesday, wasn't it? Yeah.
Yeah.
So this was formerly a lounge. It has a full restaurant. I say full restaurant. It has a full kitchen that can be a restaurant, and it was a full bar area, freestanding building. And so we like to talk about actual examples. And this is something I want to beat you up on offline, but we'll get to that in a minute. So we presented him with the property 90 days ago. The quotes varied fairly significantly. You want to talk about at least the variations, at least on this particular property?
Yeah. So this one that Michael's speaking of, like I said, it was a restaurant, closed this week. So we took that out to market. I got, I believe, 4 quotes on it originally. They ranged anywhere from, we can talk numbers, anywhere from 13,000 to somewhere maybe 2 or 3 times that.
It was insane.
Yeah, we're open book. You can go.
Okay.
We don't mind talking. This is what we actually like to do, because we're hoping the people who are watching and or listening, our whole thing is we don't want to talk about theory. We want to talk about actual situation, because this is what you guys are going to ultimately go through yourselves. And we're hoping that you can learn from the situations from us, and then you can kind of grind your own insurance broker for the things that they do.
Just grind them.
Not so good.
Way, yeah. So in that particular case, we got a wide variety of quotes. And it's, like we said, it's always ends up being what feels like a last minute thing, because we always are shopping it for you. And some of these people come in 5 days out, some 10 days out. But we presented all those options.
So the options, just for your edification, is it came in from early on. The budget we used was $7,800, $7,800 for the year. But this is a bit further out, where we didn't probably have actual quotes. We probably had projections, because they can't get actual quotes, like he mentioned, 45 days out. But I'm here trying to find a tenant, and I'm having to give them a predictive pass-through expense. So the early number we used was $7,800 for the insurance. And then when it came back, the range was $13,000 to like $30,000, which was so help us understand why there was
30,000. I didn't know we had.
I know. Well, I don't need to show you that, because that's irrelevant. That's out.
It is irrelevant.
Okay. And I think it was higher than 30,000. I think it was 39,000. So,
right.
and all of those, because each carrier, depending on the type of risk. So some carriers want, a certain construction type, a joist and masonry, frame building. Some have a better rate for non-combustible buildings, which is what this one was that we were working with, which is basically a metal building. It has some other stuff on the facade, but essentially to its core, it's a metal building.
Right.
So that carrier in particular, they had the best rate on a metal building. Now, while we're talking about that, that is the hardest risk right now to write.
Really?
Is metal building.
Why is that? Because I keep seeing that, but
that's illogical. They still have great wind ratings. Their roofs last forever, practically, as long as you maintain them. So I'm confused.
Tell us. Educate us.
My understanding on the metal buildings, why they don't want to write, is that there is a higher total probable loss. So there is a higher risk that if a certain company writes a bunch of metal buildings in the 32507 area code, that if a storm comes through, all of those are gone. There's no partial losses like it would be on like a masonry building. The way that
isn't this front of the building masonry?
It's like a stucco-ish. I don't know what
is it. A metal building that they just put some stucco over the front?
Everybody does it. Yeah. How do they do that? Because it's like even the new buildings that you think, like, we have a couple medical centers, and from the road, they look like a brand new stucco building, but they're a metal building. They're just a pole barn.
Not a pole barn.
Whatever.
A pole barn is definitely different than what we're talking about. Jeez.
But either way, yeah, it's like they're so simple, but is it so they're saying that if there is a loss, it's just such a great loss versus a partial loss. That's what you're saying?
Yeah, their mind, they model it that if the worst case scenario, Category 5 hurricane comes through Pensacola, they think that all those metal buildings
are just gone.
Specifically that are older than 2005. That's a lot of their cutoffs. There's a high probability that those are gone. So that's where those rates.
Where did they base that off? Did that
History.
happen somewhere? No,
It's an actuary science.
don't.
Absolutely.
That is made up. You are. I would like to see.
I
this.
will let Mike answer this question.
Fine, Mike.
I don't come
Show
up with
me
the rates.
the example of where that happened.
I don't have that.
Every metal building in that whole territory was gone. Did that happen somewhere?
Might not have happened here.
I don't. I said somewhere.
They all. I can see him shaking his head. So they have this history, like Michael said, and these modelings all across the state.
Okay, I could make up history too.
Then it wouldn't. It wouldn't be history. We would call that a lie.
I know where they got it from as far as they use that. Yes, I'm just saying. Please show me the event that happened that this.
Can I just point this out? This is what I have to deal with every day. This is the problem in my life. This is why I go to bed sometimes with heart palpitations, because sometimes I finish my day and start my day with Donnie, and he goes into this death loop into nowhere.
I just want to see the photo. That's all I want to know. Just tell me the storm that this happened.
Were you here during Hurricane Ivan in 04?
A lot of metal buildings.
Were you here is what I asked.
I wasn't.
Okay.
I did.
There's your proof.
Okay.
I was here. Were you here?
I was in 8th grade.
Okay. Well, he was a baby. But there's your proof. I went through Ivan here, and I can tell you what, there wasn't anything standing.
Okay.
So in certain areas.
All right. Fair enough.
But anyways.
I'll look up, what did you call this storm? Ivan? Okay.
It's September of 04. It was massive. It was our best hurricane.
Cat 4?
It was our best hurricane ever.
That sounds like a positive event.
This is so bad to say. I shouldn't say this. I don't mind hurricanes because it does get rid of old, fragile structures and it, like Scenic Highway as an example, all those trees were knocked down and you can't see the water during normal, but after Hurricane Ivan, that scenic road became scenic again, right? And then it really brings communities together. There is a positive side to a terrible event. It brings people together, that you work with your neighbors for the positive of your community. It's just, you lock arms and the community becomes so much stronger. So there is a positive. There's a lot of negative, don't get me wrong. But the positive is, I think the community comes together in a better, stronger way. So
that's nice. Beautiful. That's beautiful.
I'm a giver.
Can we do that? Can we post that somewhere? Okay,
yeah.
Let's do that. Get a bumper sticker.
So,
all right. I'm sorry. We're off on a tangent.
Going back to the hard and the soft market. And one thing I did want to point out, because I know a lot of people that invest in the properties and look at this, that is the one problem child that we're seeing that's not getting the benefits of the soft market, are these metal buildings. So it is what it is. It's the way that they model. We try our best to send it out to as many markets as possible. Those markets being the wholesalers that have another umbrella of companies under them. So, but that metal buildings are the ones that are.
Is there a certain age on the metal buildings?
He said 05.
So anything older than 05 is where the real issue is.
And that's kind of interesting because one of the asset classes that I really, really like are industrial properties, metal buildings. I like them from a new ownership standpoint, other than what we're learning today on but insurance. The asset class itself is so simple to own and manage because they have so little that goes wrong with them. So this is actually enlightening to me because I would have never thought that metal buildings would be the hardest to insure.
Now, metal buildings that are older than 05, but if you update them, and we can see proof of the updates, roof obviously being the biggest one. If you can update the roof, if you can show that electrical has been updated. A lot of times they don't have a ton of electrical unless they're, like a restaurant like we've been dealing with, but your large warehouse are going to have a ton of it. But if you can update that roof, then it opens up those markets. Like we had some people that were interested, but they wanted to see that roof replaced on it.
Now, this is what's frustrating to me. A metal building has a metal roof.
Interesting.
And these metal roofs, they don't go bad unless they have rust that goes through the screw holes, or the rubber gaskets on the screws that hold the metal panels down begin to deteriorate. And then what we tend to do is we'll go back in and replace all those screws. So if the metal is good and the screws are good and the gaskets on the screws are good, what is the problem if it's an older roof?
In their mind, it's still those original panels on it that could still be damaged. And I see what you're coming from. And a lot of people these days will do what's called a coating on it too. So if you get a license,
If we put a coating on it, then we can get our reduction.
I can't promise you a reduction right now. But
Well, no, you already screwed me this year.
Yeah, I want to go back.
Year one, I'm already.
If you can get it permitted, because that's what they want to see. When these companies come out and do an inspection, they look for the permits on there that shows work was done to the roof.
Okay, that's fine. I'm gonna accept it for this minute.
Off air.
All right, so then
Now we're getting ready to do a fastener replacement.
Where?
Literally, this is out in Crestview. I don't think they're pulling a permit for it. I mean, it's a local.
Well, you don't need to pull a permit to replace the fasteners.
Well,
Now, but is that not something that should be weighted?
That's something that we can present. See, these are things like I'm talking about presenting, painting the best picture. And if you can show that work with like a paid in full receipt, with like a work order, before and after pictures, those are things that we can present.
All right, fair enough.
Good to know.
He didn't have to pull a permit for it. I mean, it's a big commercial roofing group. And I just wasn't sure because you said permit. So as long as we can paint that.
So let's go back to this restaurant lounge that we're talking about. So we just closed on it 2 days ago. It has what, 3 electrical panels or 2?
I think it has 3 panels.
And then one of them,
the service is outside, like on a
the service is outside, but one of them we had completely replaced.
Brand new Siemens.
So the electrical has been completely updated. Not every outlet, but certainly the system has been updated.
Oh, yeah.
The mechanical,
all relatively new.
Right?
Yep.
So mechanical, electrical.
Probably within 5 years, maybe.
Plumbing was updated because they kind of redid the building about 5 years ago. And then,
we have cameraed of it. We cameraed the lines when we bought it.
Yeah. And again, I don't know what you guys focus on, but because so this is a normal process that we go through. MEPR, mechanical, electrical, plumbing, and roof are the things that we focus on whenever we buy a commercial property. And those tend to be the same things you like to focus on from an insurance standpoint.
Correct. The big thing that we ask for you guys is your bill, which that's an easy one, nothing being controlled there. Roof, HVAC, plumbing, electrical. So all of those factors come into it.
Okay. So a couple of years ago, the insurance industry, when they were trying to screw people more than normal, they had this issue with roofs, age. And relatively newer roofs, they were still requiring a lot of people to replace them or they wouldn't get insurance. So walk us through that, because it's not so hard today as it was just a couple of years ago. Walk us through what was going through the insurance industry at that time and why it's different today.
So that was, like we talked about a few times, that was the hard market. And part of that is stricter underwriting guidelines.
Okay.
So they had to be, because they only had so much capacity, they had the ability, because they had the upper hand at this point, to put in those strict guidelines, like making your roof replace after 10 years, which is unreasonable when most of them have a 30-year warranty on.
Right.
But they were in that position. But
and people weren't able to close on the property with having insurance in place, which of course is a lender requirement. So unless you're paying cash, you either had to budget for replacing that roof, or what were their other options?
So there's other options. One quick one, this is kind of a new one that we've experienced too, is you can do what's called an actual cash value, we call it ACV roof. So it changes the valuation on your roof. Now, if you're going out and getting a loan on a building, it's something you want to talk to your lender.
Well, hold on. Tell us what ACV means in a literal sense.
So ACV is actual cash value. So most of your properties that you insure are going to be, you'll see a little one that says valuation, it'll say RC. That's replacement cost.
Okay.
So that means that if a storm, a fire comes through, burns your place to the ground, they're going to pay you what it costs to replace that
ACV
building.
is like a depreciated value.
Yes.
So if you had using easy math, you have a $100,000 roof and it has a 20-year lifespan. And so 100,000 divided by 20 is roughly 5,000 a year. So if it's a 10-year-old roof, the ACV would be valued at $100,000.
So they would pay you, and they have their own calculations on the depreciation.
Right.
But if that roof gets fully damaged, they're not going to pay you what it costs to replace in 2025. They're going to pay you what it's worth.
Okay.
So
gotcha.
it's coverage.
Yeah.
It's not as good coverage.
Right.
There are some premium help with it. It is cheaper, obviously. Sometimes it's not enough I don't suggest it to people
Right.
to save money, but if
I'd like you to at least give me an option.
Well, we did do
Just
that.
say no.
Now, from a lender standpoint, though, do they have to sign off on that?
Most of the time.
No, you have to hide it from your lender.
Oh, is that?
Most lenders decided just black it out.
Just don't send it to them. But you know what I mean? It's like,
just keep this between us.
Don't share this with anybody.
We always recommend to get a lender approval on it because we don't want you to close on it. And then next thing you know, they cancel the loan. We've got to rewrite coverage.
Well, but let me ask you a question. And it goes back to my earlier conversation with, before we get to closing, you always connect with our lender, provide them with the coverage. And I presume that's the open book that we have with them. So before we even close on the property, it's required at closing that we have the insurance in place. So and then the insurance company somehow names the lender as additional insured, I presume?
Usually it's what's called a mortgagee and loss payable.
Okay.
So that means they're entitled to whatever money you're owed in the event of a claim. So they're tied to the policy. That's a simple thing. You guys are great about getting us connected with those people. Sometimes we don't hear about it till after closing. So, but either way, it's a simple process. We provide them the necessary documents. They keep it on file. Then every year or two, they reach out to us.
But during that exchange of information, you're sharing the policy where they're reviewing to make sure it's acceptable.
Correct. Yes,
Okay.
So they're seeing it on there. Yes.
So, obviously I'd say things tongue in cheek, but the reality of it is our insurance company and our lenders all work together to make sure we have the coverage that's acceptable. So if there was an ACV opportunity, they would know about it before we actually bought the
Correct.
coverage. So,
and it's part of those documents that are provided too. It's all listed on there. Yep.
Yeah. And one thing on that, it's more of just broad topic. If you can tie the people that actually know how to communicate these things because they talk the same language, just connect them. It's a lot of times people want to be in the middle of these types of things, and they're reeling confusing information back and forth, and ultimately just wasting a lot of time. It's not just insurance, but it's with a lot of stuff like that.
So we're landlords on a lot of properties. And so we carry certain amounts of coverage. And then, but we also have tenants, right? And in our leases with our tenants, we require them to carry coverage. Why don't you discuss the types of insurance that a tenant should have? And i.e., if you're an investor, what you should have in your leases that your tenants should be required to carry.
Yeah. So the first and foremost, the most important thing is general liability. So all of your tenants, no matter what the risk is, no matter who it is, where it is, they need to carry what's called a general liability policy. And the limits on are 2 million, 1 million. That's the standard state limits. That's simple enough. And most insurance agents be well-versed enough to know that's what you quote. So that covers the tenant for anything that happens on site that might be, they might be liable for it. And they always have to name the building owner. So Caro, LLC, whoever it is, name them additional insured. So you're protected as well in that coverage limits if anything happens. So that is the main thing, the general liability. And then you can always require them to carry property insurance on their own contents and any improvements they make within the building too. So that's just similar to a basic property coverage. Just like a building.
Now, I have not found it. I don't know. You can make them carry any type of coverage, but outside of the general liability, I don't know that we require them to carry contents coverage. We want them to understand that our property coverage for the perils on the building will not cover their personal effects. But I like people to understand it's up to them whether or not they want it.
Yeah.
Also, when I get a tenant that wants to not update, but change the language, when we send them a lease, there's a little bit of horse trading as to sometimes they'll want changes. And I just had something at one of our properties and they wanted to change all the lease language. And I said, our insurance language within the lease. And I said, listen, you can do whatever you want, but you're going to run it through Mike Price. You always want the section of the insurance that somebody may want to change because he's already reviewed it for our lease. You want to send that insurance section, either send it to your insurance carrier to approve or have them give you language to insert into your lease, but you shouldn't do it yourself. And so if a tenant ever wants to change that language, just connect them with your insurance carrier. And because I like them to connect anyways, so they're not accidentally writing duplicate coverage for their property. And so I just find it easier to do it that way, but I will not redline changes in an insurance section unless my insurance provider approves it.
Correct. Yeah. So there's we see a lot of things in leases people share with us, like plate glass coverage. They want to protect the windows. All that's covered under the property insurance. People require workman's comp, auto. All of that is really up to the tenant. The main thing that we always require is just that general liability and named additional insurance.
Don, from a property management standpoint, we know that triple net, one of the ends is property insurance.
Mm-hmm.
Walk our listeners through how that is calculated from a triple net and how you provide that on your invoices.
So typically what we're going to do is get the total value provided by Mike. What's the entire amount of insurance carried by that property? General liability is part of it. So there is a property, general liability specific, not just the tenant. We have the property insurance. And then sometimes there's other layers like business loss income, right? Is something that we'll have in there. And what we'll do is put that package together, total amount of insurance, and essentially just divide it by the square footage of the property. And then what we're going to do is allocate that on the pro rata share of the space that they're going to occupy. So if they're, a 10,000 square foot building and they occupy 1,000 square foot in that building, they're going to pay 10% of the annual property tax. And typically what we're going to do, some owners want it done a specific way. The best way for, I would say, new owners to do it is going to be essentially add that line on the invoice, collect that money, and actually set it aside so that when the insurance bill comes due, next year, you can pay it in full and you don't have to strike that big check. Typically, the way we run it is we will actually just, leave it in there. We account for it differently, but make sure your property taxes, your property insurance, these big bills that you're squirreling away a little bit of money, don't actually issue those as dividends to yourself, because then you're all of a sudden going to go at the end of the year, oh my gosh, I got to write this big check.
Right.
So we're always trying to account for that when we do it, but typically they're just going to pay a pro rata share.
Mike, if you have a 10 tenant building, and let's say one of those tenants somehow has a much higher risk, which affects the overall premium. So in Don's example, everybody has kind of an even type of risk, but there's probably, I don't think we have what I'm trying to describe here in any of our buildings right now that I'm aware of. But if we have a 10 tenant building and you have one tenant that has a much higher risk from an insurance standpoint, is there a way to bifurcate that premium so that one tenant pays a slightly different share based on their higher risk?
To my knowledge, we haven't had to deal with that. It sounds like what you're saying. If you've got, 9 office spaces and you got a guy that's doing welding or something in there,
right?
Something kind of crazy. We could, and this wouldn't be exact, but just kind of the way I'm thinking right now, you would run it as the cost for a 10 office place,
right?
And then what it is, and then you can find that difference. But that's not something we come across too often, but it's something we could probably find a way to do.
Well, because I did ask you a question a while back that you still couldn't answer, so I'm gonna ask it to you in front of everybody. So, you have a building, you have a 2-story building, you have the first story that has all tenants, and the second story has nothing. It's just a vacant space. You certainly wouldn't divide that equally.
No, and you'd want to take that square footage. And we just want to know what square footage is associated with what. And
right.
On this, I know which one you're talking about. That one would be pretty much split pretty evenly on that. We would just need to know who's got much square footage, and we would divide that by the premium and the TIV, and then come up with kind of that, who's allocated to what amount. We've done that in the past too.
Yeah.
No, why would it be even? Why would it be even?
Because there's on this one in particular, there's not.
I think I know which property you're talking about.
It's all that. There's nothing causing a rate, increase or decrease from the tenants. You know what I'm saying? It's really.
But there's no.
Well, that's
on
not
the second floor.
That's
there's
not
no
true.
Infrastructure, right?
But who owns the second floor? Who's using it?
Nobody. It's a vacant space.
Okay.
So, I disagree because the first floor in this example has invitees, right? they have occupation, they are running businesses, they have people coming in and out. So their general liability risk is much higher.
But the property should be less, right? Because isn't vacant more expensive?
Vacant is more expensive. Yes, from the liability side.
But if there's nothing in this space, the second floor.
Well, but then I'm thinking that if I'm occupying a space, if I'm having a party,
parties,
well, then I have a higher risk of people setting my building on fire. I mean, I'm being exaggerative, but still, I would think that the cost of potential liability is much higher.
Right.
Okay.
So on the liability side, when you get a liability quote, and there's different exposures. So it'll say, restaurant exposure, things like that. That one's easier to break out. The property coverage, everything in one building, like this one we're talking about, is one rate and one TIV. So it's harder to break out.
No, I understand.
Coverage, yeah.
But in my world, I have to value spaces. And if I have 4 spaces completely built out with restrooms, with electrical, with mechanical, with everything, that has a certain value. And if I have an empty space with no infrastructure, like Don mentioned,
that's the part I'm getting hung up.
You know what I mean? I mean, that
has no HVAC that's being insured, has no panels, has no.
Yeah. And I think that'd be something more that we just had to sit down and come up with.
Because it's more like a storage space, essentially.
Exactly.
So again, I'm just, but you see,
this is what happens all day.
This is
all day with these guys.
I'm just saying that most of the things are not perfect boxes. And the good thing is we have a lot of properties that are just single tenants, easy, right? Or we have a lot of properties that, might have 10 different retail spaces, but they're all kind of the same. We have office buildings that the whole thing is an office building, no big deal. But those are the easy ones. And Mike does that all day long. But we have to challenge for these unique situations because they do come up. And so we have to think outside the box because they won't,
That's what we do. It's all we do. All right, wrap it up. We got to.
Where do we got to go?
We just got to transition.
That's it. Our producer is telling us.
He's saying wrap it up. I said you 3 minutes. What? 12 minutes ago, I told you.
I didn't hear anything about 3 minutes.
I didn't say it. I wrote it and shoved it to you, but you're looking up.
Well, hey, okay, that wraps up another. What podcast is this? That wraps up another Blue Commercial Real Estate. No,
Blue Dirt.
It says it right there.
Blue Dirt.
That wraps up another Blue Dirt Commercial Real Estate Investing podcast where even idiots can make a killing in commercial real estate. If you liked this episode, you probably didn't. But if you do like it, please like, save, or what's the other one?
I don't know. You're an idiot.
Share, subscribe. That's the one. Hit that subscribe. Yeah. Punch it. What did they say? Pound it.
Smash it.
Smash it. Do anything with that subscribe button.
Let's get out of control.
Thanks, guys.
That's a wrap for this episode of Blue Dirt. We're here to help you build smarter, invest wiser, and create long-term value in commercial real estate, one solid foundation at a time. If you found today's insights useful, be sure to subscribe so you never miss an episode. And if you know somebody who could benefit from these discussions, share Blue Dirt with them. Got questions or topics you'd like us to cover? Reach out. We'd love to hear from you. Until next time, keep digging deep, stay sharp, and remember, real value is built from the ground up. See you on the next episode.